Day zero is like, I picked up a phone and I called a phone number. I said, hi, I want to apply for a bank license. And the woman said, yes, you should send us an email.
Hello and welcome to In Control, where we learn about the finance of everything. I'm Tash, your host, and I'm also the CEO and founder of Cable, which supports the show. My very first job out of university was in the working capital team at Ernst & Young, where the lesson and the thing we sold was essentially don't run out of cash. It doesn't matter how much money you make or how fast you grow. If you don't have cash in the bank, you'll die. And whilst that is a really simple concept to wrap your head around, it's way harder than it seems in practice. What goes into that is not just how you make money today. It's how you collect payments, how and where you spend money, how you budget for tax payments and bonuses and employee holiday gifts. It's how you build that new product that you're just sure people will buy before you're making any money from it, and how you intend to make money next year. There are almost endless cool ideas for new businesses. Fun things that people might want, ideas that could make businesses run better or people happier, and those businesses on the face of it may not have anything to do with finance. Apart from, finance is everything. Ensuring you have cash in the bank is everything. We've started this podcast to learn about the finance of everything, and what better place to start than learning about what a bank is, how a bank makes money, and why, when it's so damn hard, would anyone want to start one? To help me understand all of these things, I'm excited to speak to a friend and fellow founder, David Jarvis, CEO and co-founder of Griffin, a new bank in the UK that positions itself as the bank for companies who want to build and launch financial products. David, thanks for being here to teach me all about what a bank actually is. And please tell me, why did you decide to start a bank?
So when we raised money from our seed round, which was co-led by the two co-founders of Indeed, when asked why they had started Indeed, they had said, well, because we were basically unemployable. I think that's kind of the answer to this, is like, it seems odd to have chosen this, but I think I literally could not have done anything else. I was very unhappy with where I was in life. And the only thing that I was interested in doing was dusting off an idea that a friend of mine had, which was pretty crazy, but which seemed like a really, really good idea. And it's just literally the only thing that I had any interest in doing. I was miserable working for other people. I thought anything else that I do that involves me working for someone else is going to make me miserable. And if I'm not going to work for anyone else, I need to have a good idea. And the only idea I've got is this thing that my buddy Dan came up with. So I'm just going to take his thing. And 8 years on, like, his idea is still pretty good. And yeah, we've come a long way.
And specifically starting a bank rather than just a fintech, or, why the licensed entity part of that?
So I think the starting point is really what were we trying to do, right? Like, it's not like maybe on some abstract ego level, I wanted to start a bank because I thought it would be impressive, and I have a need to impress people because I'm an insecure person.
There's every startup founder in history, probably.
Yeah. But more foundationally, the thing that we wanted to do was, like, I'm a developer by background, and the appeal was like, okay, API access to the banking system is really cool, right? Like, it's just foundationally cool. And it turns out that a lot of other founders want it and need it for their businesses. The problem is that if you just try and solve the technology part of this, you run into like a brick wall, which is actually dealing with the financial institutions and the counterparties and the regulatory environment that's on the other side of it. And so if you try and only solve this through technology, you will deliver no value because the system is not set up to deal with founders and technology-led businesses and all this stuff. And the only way that we could perceive, solving that problem was like, all right, cool. What if we just owned that also? Like, what if instead of trying to like be reliant on these other people who are never going to get it, we just like own all of that? And obviously that's like really, really hard. And many people were like, well, it's just not possible, right? The regulatory environment just does suck. And like, even if you build it, you're still going to end up constrained by the same things that constrain these other players. Turns out that's nonsense. Like, the reason that most banks are terrible is a combination of like a legacy of M&A. So they've just like acquired their way to a spaghetti rat's nest thing that can't make decisions quickly, is a nightmare from a technology perspective, et cetera, et cetera. And the rest of it is just like follower behavior and kind of received wisdom where they're like, oh, the regulators want this. So the cool thing about being the CEO of a bank is you get invited to events by the Bank of England that are like their annual CEO conference where they tell you what they think, like just to your face, right? And they're like, cool, we don't give a shit about best practice. Like whatever anyone else is telling you about what best practice is, we're not selling that. Like, and we find in our experience, what people say we want and what boards think we want is often very different from what we actually want. If you want to know what we want, there's two ways to find out. We've either written it down and published it, or you should just come talk to us. Like those are the two ways you'll find out what regulators want. And it turns out that actually works really well.
That sounds amazing in theory. And I am very excited to have the whole of this conversation because I have some anecdotes from my time at Monzo that I don't think align with that. But maybe the tide has turned because that was, 5-6 years ago now. Okay, so much to get into today. I want to start with how do you actually build a bank? Like, what do you do? So you had this idea, your friend Dan said, call David, go do this thing. Yeah. What do you do to start building a bank? Do you like sit there and read? Is there a book called How to Get a Banking License? Like, what do you do?
There isn't a book. Fortunately, there are people, right? So the easiest thing in our case was to go and find the people who have done it before. And so case in point, like we just went and tried to talk to all of the other founders of the other challenger banks. And so you and I have talked about this before, like Tom Blumfield is basically the only founder of Monzo who I haven't spent a lot of time with at this point. Like I've spent like a considerable amount of time, especially with Jonas, who was very, very generous with his time, which was also just the wildest connection in the world because I reached out to my friend Kyle Wild, who lives and is a founder in San Francisco. And I was like, hey, I want to do this like wacky thing, blah, blah, blah. And I'm going to move to the UK to do it because I think that's the right regulatory environment. And he was like, oh, cool. And I mentioned that one of the sort of catalysts for us was that Monzo had gotten their license. And he was like, oh, cool. Do you want me to connect you to one of the Monzo founders? I was like, oh, that would be awesome. Like, what's your connection? He was like, oh, we go to Burning Man together. And I was like, great. But I mean, and I've never been to Burning Man, but the cool thing about the Burning Man ethos is it is like an ethos of kind of, sharing and kind of a giving without expectation of receiving, right? And just like paying things forward. And so, like in that first conversation with Jonas, he was kind of like I was like, here's what I want to do. And I think I can solve these problems in these ways. And he was like, and how are you going to do this? And I was like, I don't even know what that thing is that you just mentioned. He was like, okay, cool. You're going to need to go and read this book. You don't know anything about compliance. Let me tell you where to get started. It is the Joint Money Laundering Steering Group. Like, go and read their recommendations end to end. That will tell you like 90% of what you need to know in terms of just like the scaffolding for financial crime compliance in the UK, right? And then there's like just like the really mundane thing of like, literally, how do you do this, right? Like, how do you actually like apply for a bank license?
Yeah.
And I think there's like a little bit of this kind of fantasy that people have in their minds where you show up with this, giant vanilla envelope and you kind of plop it on the table, right? And then 2 years go by and they come back with a yes or no. That's not the way the UK works. The way the UK works is very iterative. You share materials, they give you feedback. And this process is one that's designed to be better for the applicant. And it is better for the applicant because you get to get regular review and feedback as you go. Yes, it takes longer, but on the other hand, you can run this process like actually quite lightweight, right? You don't need a large team of people while you're kind of doing this kind of material workshopping. But the day zero is like, I picked up a phone and I called a phone number. And I said, hi, I want to apply for a bank license. And the woman said, yes, you should send us an email. And she was like, this is the email address. And you should include a deck that says what you want to do. It's like, okay, thank you, ma'am. Click. So then we spend a week or two kind of building this deck. And it says, here's the products that we want to offer. Here's the customers that we want to go after. Here's how we're going to be funded. Here's the kind of broad governance structure. We sent them the email And they came back to us, and it was basically like, we want to hold money for fintechs and process payments for fintechs, and then we're not going to do much lending, but we might offer some overdrafts. And they were like, no. Our view, the PRA's view, the Prudential Regulation Authority, the UK's banking regulator, our view is that the legal definition of a bank is a firm that takes deposits, but legally, deposits means takes customer money with an eye to lending it out. And if we're going to be honest with you, your little overdrafts thing here doesn't really feel like a plan to lend money out. It just feels like a kind of asterisk that you put at the end of this deck. So like, go away and have a think about that, and then come back to us when you have a serious credit strategy. We're like, okay, cool. It turns out that we did have some market evidence already that actually the most adjacent thing that would be really compelling for us that was synergistic with the rest of the platform would be warehouse facilities to fintechs that we would bank, generally non-bank lenders. So we did a bit of work kind of developing the business case for that. And then we came back and said, all right, cool, here's the updated deck. And they said, cool, this looks good. Why don't you come by for a meeting at our Moorgate office on this date?
And at this point, like, you haven't got your full business plan. Have you modeled it out? Have you got like a 5-year financial model and like board members?
Yes, but like it hasn't been touched by a CFO. It's been written by me. Right? Like, wow. It's like, so yeah, that's it, right? It's like this was enough to survive like seed investor scrutiny, but like obviously lots to come. So my co-founder and I put on suits, which is very funny. We had hired the chair of our board, which is another story. And I think we had also hired a COO and a CFO, and we all went in and we had a kind of lovely little sit-down conversation with some not particularly great coffee and biscuits for about kind of 90 minutes. And they said, okay, cool, this is what you can expect from us, from the process. The next thing that we're going to ask you for is a regulatory business plan. Here is what we expect this to cover, but you can also look on our website and it will go into the details of everything that we expect to see in a regulatory business plan. And that should be approved by your board. So it needs to be challenged by your board, reviewed by the board, approved by the board. Then you'll send it in. We will give you feedback and we'll let you know when we think it's kind of like of an appropriate level of quality. So they did this. By the way, like as soon as we drafted the first version of our RBP and submitted it, like COVID happened. So everything got really weird already. So the Bank of England kind of moved into remote working. Everyone moved into remote working. And then you have to do this kind of process again, twice more with your capital adequacy plan, which basically says how much regulatory capital you think your business requires, as well as your liquidity adequacy plan, which basically goes back to what you said in the intro, which is like, how do I prove that at no point in time am I going to have a shortfall in cash on hand to satisfy my immediate obligations? And once you work your way through all of this, and generally, so you'll send something in, they'll take a month or 2 or 3 or 4, unfortunately, in some cases, to review it. They'll then send you a couple pages of feedback, maybe somewhere between 20 and 60 kind of questions and comments on, you know, we'd like to see more detail on this. We noticed that you have this. How are you going to manage this risk? Blah, 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 blah. I'm going to work your way through all of this. And then they used to say, all right, like we're satisfied. We invite you to apply. They no longer say this. Now they just say we have no further comments. And when they say that they have no further comments, what they mean is if you apply, we intend to accept. And if in the UK, if we intend not to accept, we'll find various ways of signaling to you that your work isn't good enough. And you'll just spend years in this process, right? And some of these things that we'll signal to you, we'll soft signal to you, are surmountable, but you've got to be willing to surmount it. So, classic example, our original COO had, in the wake of the financial crisis, been at a large lender, sort of securitized lending, that made the decision in the wake of the financial crisis and the wake of the new regulations to transition to being a bank. And the CEO, who was the majority owner of that business, was a little, let's say, larger than life. And they got through the process. But at the end, the regulator said, we're prepared to authorize you, but that guy can't be the CEO. In theory, surmountable problem, right? Guy owns the full thing. You can just put in place a professional. Yep. He's going to control the board ultimately because he's a majority shareholder. So even if the board directors are independent, he can always fire them and put in new ones. But instead, he just said, no, fuck you. Like, if I can't run it, I don't want it. And like, just basically like took a match to 2 years of work. So it'll be that sort of thing. Like famously, like Revolut obviously took long time. One of the reasons why it took Revolut a long time is because they had multiple share classes, and the regulators want you to only have one share class for capital purposes.
Yeah.
And some of the shareholders who held the pref shares essentially held Revolut hostage and said, we will not allow you to convert our shares to ordinary unless we get paid, basically.
This is fascinating. What is funny hearing you talk it through like this in a sort of, concise little story form is that actually...
It took 4.5 years of my life.
Well, I'm sorry about that pain. No, what I find interesting is like this kind of, you have to have a really thorough business plan. It has to go through a review and comment by a group of senior people who are presumably very experienced in this particular subject matter. And we want a really thorough financial model. And you have to prove to us that you're not going to run out of money. Those just seem like really good things that maybe all investors should be doing. And it's funny, actually, like when you think, well, maybe this is my naivety showing. When you're young and you think, oh, maybe one day I'll start a business. You're like, okay, I'm going to write a business plan. I'm going to make it really, really, really good. I'm going to have this financial model that shows I'm never going to run out of money.
Do you know what's funny? It's like, because I come from the hacker ethos, I don't have any of that shit. I'm like, I'm not going to build a business plan. Fuck business plans. I'm not going to build a financial model. Like, that's fucking boring. Like, maybe I'll spend like 15 minutes just making sure the unit economics are survivable.
Yeah.
I'm like, let's go straight to building. Let's go straight to building and figure out if someone wants to buy this before I do any of the rest of that. Because the rest of that is just like, it's masturbatory. It's like intellectual, like you can convince yourself of anything, but the truth is, can you build it and is someone going to buy it?
Yeah. Which I guess is maybe the law degree and accounting qualification in my background coming out. All right. Let's move on from that embarrassing anecdote then. So you mentioned, you had this like business plan early on that was good enough to raise money from seed investors.
Yep.
Presumably raising money to build a bank, there are capital requirements. There are maybe only one type of share class that you can have. Preferred shares are off the table. Talk to me a little bit about the differences between raising money for a regular startup and a bank.
It sucks. So I had to raise 50 million pounds with no revenue. That is incredibly hard to do. And it is somewhat structural to building a bank, especially a clearing bank or an infrastructure bank, which is what we are. Because in our case, we didn't have what Monzo and Revolut and a lot of the other challengers had, which was the ability to build something that was materially revenue generative without having the bank license, right? So a lot of those businesses were able to survive by getting a prepaid card out or building on FX revenue. For us, our core customers, and it's maybe worth talking a little bit about kind of what we do for a second, right? So we bank fintechs and platforms. When you look at the fintech side of that, which is 2/3 of our client base, they are regulated non-bank financial institutions. So they're payments companies, wealth businesses, insurers, non-bank lenders. Some of them are in property. The general theme is the law requires them to hold customer cash at a commercial bank. And if you do not have the bank license, you cannot solve their problem. And so for us, it was very, very 0 to 1. And that made this business uniquely difficult. Whereas a lot of the other neobanks, were able to get something into the hand of customers, particularly consumers, that did the job and enabled them to prove traction and build revenue without this. Raising money with no revenue is something I would not recommend in general, and especially not past the seed round. We've had to do a lot of rounds without revenue, which has been very, very difficult. The other side of this is not having a pref stack is a double-edged sword. So pro, even if we go to 0, I'm going to get paid out something at the end. Whereas in a normal startup, there's this thing where you can be underwater on your pref stack, which means you as a founder see nothing, even if your investors see something. That's kind of cool, and it is a very powerful incentive alignment mechanism, but it does make it very hard to raise money from VCs who like to have the liquidity preference on shares. And for people who are unfamiliar, what a liquidity preference just means is if I'm going to invest 5 million, if a business is sold, I am guaranteed to get paid back before anyone else gets paid back. Controversially, liquidity preferences are really stupid. I have a lot of hot opinions about this, but here we go.
Hot opinion.
Liquidity preferences are really dumb for investors to optimize over because for 2 reasons. First of all, they will generally not actually affect the overall performance of an investor's fund. You are looking at the difference between getting paid 0, a lot, or something around or less than 1. The around or less than 1 doesn't matter. It is a rounding error in your overall fund returns. And then the other side of it is, if you as an investor are maniacal about liquidity preferences, the thing that happens is that other people layer more aggressive liquidity preferences on top of you. So then they get paid back first, not you. And so it actually doesn't really serve you all that well. So although it's made fundraising very difficult, it's one of those things where, I mean, if I'm ever going to start another startup, I'm not sure I want to take outside capital anyways. But if I am going to take outside capital, I think, ironically, I think I might push it the other way around, which is like go for the Zuckerberg, like super shares, right? if I can. But failing that, I would always push for just like flat, ordinary, no liquidity preference and just say, no, we're all on the same table. Like we're all at the same like tier. We're all equal. And if you don't want to deal with that, like I'm not interested in having you as a capital partner.
Yeah. So you have to raise just a huge amount of money in order to be given the license, period. And in your particular case, there's that without any revenue.
It's also just an expensive business to run. So we get hauled over the coals for this quite a bit, even now, where, you know, investors kind of look at us and they go, oh, so burn rate is so high. And I'm like, this is just what it costs to run a bank in the United Kingdom. I have now looked at the accounts of, so cool thing about the UK in general is like a high corporate transparency regime. So everyone has to publish their accounts, and banks especially have to publish quite detailed accounts every year. The cool thing about that is you can look at every other new entrant bank and what their financials are. And I'm like, cool, it costs every bank in this country, regardless of how big or small they are, about £1 million a month to run, period. Like it is not possible to reduce that cost any further.
What is in that cost?
So in that cost will be a finance team that's got to be generally at least 5 people. A risk and compliance team that, again, is going to be at least 5 to 10 people. You're going to have non-executive directors that have to be paid. That's also at least 4 people, usually 5. You're going to have an operations team. And now you come to the rest of what a normal business looks like, right? And the rest of the normal business, right, is going to be whatever, customer success, sales, product. Product and engineering also for new entrant banks that are not technology-led, often outsourced, but even outsourcing it is ludicrously expensive. So you're still looking at like banks paying millions a year just to have a core banking system that works, because like having a fully fledged regulatory compliant core banking system in the UK is really hard. Yeah.
So let's talk about that for a little bit. You know, hypothetically building this bank, you're applying for the license, you've done this regulatory business plan process, it's been reviewed, they've said, cool, you can do this thing. Yeah. Whilst all that is happening, presumably you're building something.
Yeah.
What on earth do you start building when you're building a bank?
So I think you start with an accounting system, basically. You start with a double entry ledger, which is just the most basic thing. Amazingly, not everyone starts with this. So this has never been like sort of like confirmed by the press. But you remember like if you see me looking at my phone, it's because I'm checking my blood sugar, which is like a little bit on the low side. But I did eat 2 ice cream sandwiches before we started, so I'm reasonably convinced that I'm going to be okay. One of the issues that they had was that I can't remember who their auditor was. I want to say it was BDO. It might have been PwC, Revolut. Could not confirm their books. And I would put a significant amount of money down that the reason that they couldn't confirm this was because I bet the Revolut at that time was not running on a double entry accounting system. I bet it was running on a single entry accounting system or a transaction log, which is what a lot of people in payments try to do, which, by the way, always ends up with you shooting yourself in the foot. Mm-hmm. So that's the thing you start with. The next thing you want probably is what we, in the early days, called a customer information system, which is basically, all right, cool. Now you've got like ledgers and accounts and some idea of debits and credits and positive value and negative value. The next thing you want to figure out is like linking that to ownership. This was one of those places where again, Jonas just kind of blew my mind, where he's like, cool, like you're going to need to prepare yourself for stuff that you aren't going to have thought about. And the sort of examples he gave are like, there are things that you think of as facts that are actually political realities that can change at any time. Like, famously, time zone is one of these within the engineering world. Like, we think of time zones as like a thing that's established, but actually like a government can just vote to change the time zone at any time. And that's happened multiple times in the last 100 years. And like when that happens, a whole lot of software engineers have a very rough couple of weeks. Other things that are relevant to core banking systems are like, hey, cool, you've got this person registered at this mailing address. Russia has now taken ownership of that particular territory. Are they in Russia or are they in the Ukraine? Like, and who do you report that to, depending on which jurisdiction you're regulated in, right? Like these really messy, like political, hard edge questions. You need to start thinking about that stuff really early, because otherwise you're going to design a system that makes it impossible to reconcile with the political reality, and banks are deeply political entities. So there's that. Above the ledger, you want something that looks kind of like a transaction engine. And this is, so the ledger you should think of as sort of finally settled things, right? So I have paid you £5. Congratulations, like that goes in the ledger. What you don't want going in the ledger, and you want stopping at the transaction log, is like, I tried to pay you £5, but actually when I put that payment into the faster payments central infrastructure, your bank didn't respond in time. And so now that's in like a weird state where one of us has it as a payment and the other doesn't have it as a payment. It hasn't settled. It has to be backed out. You don't want that going to the ledger because it's not actually a movement of money that has happened, right? So you want to deal with all these horrible, nasty edge cases here and try and keep them away from the ultimate ledger. Mm-hmm. But you still need to render the kind of logic of what's happening here to the customer. Above this, you have, maybe linked to the customer information system, you have like a workflow engine. You're going to have two classes of workflows. You're going to have workflows that deal with people and products, and you're going to have workflows that deal with payments broadly. I think that's generally true. We don't do credit yet, but that kind of goes in with the people and product side of things. These are endlessly complex and are often going to end up with you owning some amount of workflow orchestration and you needing to hook into various other systems on data collection, right, for credit underwriting or customer due diligence or for transaction monitoring or what have you. And then, if you do issue cards, which we don't do yet, you have to hook into Visa or MasterCard and also into card processor. And at that point, you've got most of what you need to run a bank.
Sounds so simple. I remember one of our engineers at Monzo, literally over the course of about a weekend, reading like 101 accounting to understand debits and credits so that he could build us this double ledger core banking system. Did you also read 101 accounting?
No, because I had the advantage of having worked for Dan Kimmerling. So I had the advantage of getting to do a little bit of this on someone else's dime first.
Okay. Okay, so that sounds, totally simple, sure. You've built all of this really complex stuff. The double entry ledger, you've got the transaction system, you've got the customer information system, you've got these workflows. Hypothetically, this all sounds great. And now I'm imagining you trying to test this. Where does the money come into this? Like, this is all just computing. Mm-hmm. Where is the, like, here is my £5 note and do something with this? Yeah. Where does that go? Do you have a safe with all the notes in?
Ironically, we do have a safe, but the safe has hardware encryption keys in it, which is a sign that we are like a modern bank. We do not have any gold in the safe.
That's kind of a shame. Wouldn't you kind of like to have just like the odd bar of gold in your safe?
Yes, but then I would have to have a higher capital charge on my operational risk weighting than I do at present. Which is the sort of like second order thing that bankers think about all the fucking time. So
how do you test this all works? Like, here's my money, do something with it.
So I think here we get into the idiosyncrasies of national payment systems. The U.S. is a little bit beautiful in this regard, and it's one of the things that I underappreciated. But in the U.S., basically, if you're a bank, like the expectation is you can and will get access to the Fed. It's not going to be unreasonably withheld. You don't have any third parties to deal with. And so the way ACH works is like you upload a file to an FTP that is run by the Fed. The Fed clears it over the course of 3 days. And at the end of that, like your account at the Fed now shows a different number. And that's what money is like the Fed says that you have this money, right? In the UK, it's irritatingly more complex. So the Bank of England serves a similar function. They have reserve accounts. You as a bank can apply for one. When payments clear and settle, your account at the Bank of England goes up and down. And this isn't all the money that you have necessarily, but it's one way of knowing that you have just received money from other people. The problem is in the UK, all of the payment schemes are run as co-ops. that are actually quite complex and difficult to get into. And so your starting position for almost all new banks is you will need another bank to clear your payments for you, which actually, yeah.
I mean, that's
so
nuts.
It is nuts. It's totally weird and nuts, and also not optimal, right? So again, another example in which Jonas served us very well. We were like, hey, we went and talked to Barclays, and they said no. We can't even find the person at HSBC to do this for us. We talked to someone at Lloyd's, and I'm not going to tell you this person's name, but they were a moron. And Jonas was like, yeah, we work with NatWest. Like, is it amazing? No, but like, it's fine. And that was largely our experience. Like NatWest, given that we had no other options, and if we hadn't been able to get NatWest to do it, we might have been actually fucked as a business. We owe a lot to NatWest. They have been like good business partners to us. Their technology is a very, very strong meh, right? But it's terrible that that's the way that it is, right?
So they are actually the ones holding your like ultimate money.
So let's say so again, we bank fintechs and platforms. So there's I'll just use one of our customers. One of our customers is a customer called Sidekick. So they do kind of investing for the mass affluent. So let's say you, Tosh, want to open an account with Sidekick, and you want to put some money into one of the funds that they have on platform. In order for you to do this, you need to deposit cash with Sidekick, which is in fact a Griffin account. So you open an account on Sidekick, and they give you an account number and sort code with which to send the money. And you go to Monzo and you say, great, I want to send money to my Sidekick account. What then happens is, let's say it's a faster payment. So Monzo, I think, is at this point a directly connected settling participant. So Monzo goes to the faster payment CI. They look up the sort code and they see, that sort code is actually owned by NatWest, of which Griffin is an agency bank. The money settles into NatWest's reserve account. NatWest then credits the Griffin FPS settlement account, and that is how we know that a payment has been received to the sort code, to customer account number linked to Tosh, linked to Sidekick. We fire a webhook to Sidekick, and Sidekick goes, okay, cool, I've now credited Tosh's account with this money that's just come in. This is really messy and weird.
Yeah, and is this like to protect the payment system from...
No. It's not a vestigial organ. It's just an accident of history. This is not how, again, because the U.S. system looks different, right? Like the U.S. system, you just connect directly to the Fed and that's it, right? There's no sort of second order scheme that you have to buy into.
So after a while, will Griffin be able to become
yes?
A
So
member?
we're about halfway through the process. So we at the time we were authorized, we didn't have and we couldn't get a Bank of England reserve account because the Bank of England was in the process of upgrading their internal systems. So they put in place a freeze on even getting access to a reserve account for over a year. Unfortunately for us, the month that we got authorized. So that was a huge blow. We now do have access to this. The next thing is applying to become a direct member of, by the way, you don't just get direct membership like all in one go. We have like 4 payment schemes, technically 5, but I'm not acknowledging checks. Like in the UK, checks are basically dead, right? And 3 of these really matter, right? So faster payments is the big one. CHAPS is for big, real-time, instant clearing payments. And then BACS is closest to ACH. It's a multi-day settlement rail that also has direct debit. So you have to apply for each of these separately. They each have different rules. Some of them require you to post collateral with the scheme that is, in some cases, quite large. And so we're like, okay, cool. Faster payments is by far the one that's most important to us. So we began the process of applying a couple of months ago. We couldn't even apply until we had the reserve account. So we couldn't like front load any of this or run any of it in parallel. And we expect to be direct participants by October, and which will be the point at which we are direct settling participants in one of the like 5 schemes in the UK. It's not a super friendly system.
And presumably all of this just simply goes to increasing that burn, because presumably you're paying NatWest to do that settling for you. Presumably all of these applications cost money, et cetera, et cetera. So that's a really nice segue to tell me how...
Thank you for reminding me about that, by the way. That's famous.
Sorry. I want to understand how banks make money. Tell me about the sources of income for a bank and and maybe those kind of unexpected ways that you as a modern bank have found to make money, and then tell us also about the costs involved.
Oh boy. So I mean, let's talk about costs first because you've already covered a bunch of them. The other things that are non-obvious are you're going to need internal audit. This is for a small bank, often a firm that you hire. So you'll hire an auditor, but these are your internal auditors, not your external auditors. So they're not financial auditors. They're like reviewing your risk and compliance environment and recommending improvements to that. You then have external auditors who you're paying like at least $250,000 a year to. And the reason you're having to pay them so much is that like if they sign off your accounts and get it wrong, they will go to prison. So it's actually, I mean, they're very strongly incentivized to charge you a lot of money and to make sure that they get it right. And again, this is one of those places where, you know, in our first year of operating, we weren't sure that we could get an auditor to work with us because we were like, we're a pretty weird bank. Financials, you know, are going to be very unusual relative to a normal savings and loan type operation. If no one will audit us, we will have a real problem. So there's that. There's all the people costs. You end up eating up, I mean, a considerable amount in legal, but you can kind of manage that. I mean, you know, there's a lot of kind of ordinary business costs. As you say, though, I mean, you do, you're going to pay someone else for your payments, which is very, very annoying. And then let's talk about kind of revenue. So we're an unusual bank in that our direct customers are corporates and they are paying us to run financial products that they offer and forward sell. So everything, you know, in terms of how we're structured is kind of on like a cost plus basis. So like if we incur a cost on payments, we're going to forward propagate that to the customer and they're going to have to pay. We earn some net interest. So they place deposits with us. We pay interest on those deposits. So our customers do, in the large, make money from working with us. We then get to deploy those deposits productively into a combination of loans, treasury, putting them at the Bank of England and earning yield on funds held with the Bank of England. We incur costs on payments. We incur costs everywhere in terms of like onboarding, transaction monitoring, regular kind of KYC refreshes. And a lot of this has to get...
Are you passing all those on? Are you marking them up?
We are passing them on and we are marking them up. Yeah. Now, if you're building Monzo, this looks very different actually, right? Because you're not charging for the fees. You're not charging like an account fee. Instead, what you're trying to do is to say, and this is very kind of modern neobanking, challenger banking. You're trying to say, how do I build a really compelling value proposition that is sufficiently compelling that you'll allow me to charge you fees, right? And this is kind of the direction of travel for a lot of the neobanks is this kind of like premium tiers where a customer pays a subscription fee and that unlocks additional benefits. But ultimately, the banks need to be able to be profitable without that revenue stream. And so the way that a Monzo or a Revolut will make money is on, you know, traditional classic banking, which is there's going to be some amount of they're going to pay some amount of interest on deposits held, generally not a lot. They're going to earn interchange on every card swipe. They're going to earn some amount of FX revenue on international payments, and they're eventually going to have to do loans because lending is by far the most lucrative thing you can do as a bank, like by some considerable margin. If you're a European bank, your client base will move around a decent amount and will spend in multiple currencies fairly often. And so FX revenue is pretty big. It's a pretty big second order one. So you'll see kind of like, you know, lending's the big one, and then FX is pretty big. Card issuing is less big because we have regulated interchange here in Europe. In the US, the dynamics are flipped, right? So no one makes an FX transaction when they go to Texas to New York. It's all dollars, right? So very little FX revenue, more for corporates, but not on retail. Card interchange, by comparison, is uncapped, particularly for smaller banks. So card interchange is a major revenue driver in the US, but still lending kind of dwarfs the thing. The weird thing about us is, again, because of our structure, you know, I forget what the actual number is right now, but it's like 70, 80% fee revenue relative to net interest margin. Like that's not normal. But it's really nice for us. And it kind of goes to our structure as an infrastructure bank being very different from a normal bank.
Yeah. Okay. So generally for banks, it is still lending. And then there's how can you make fees supplemental to that, basically?
Yeah. So, and this is like one of these interesting things. So if you look at the way that banks get valued in public markets, they're generally valued on the basis of what is the primary constraint on banks? What stops banks from growing indefinitely and consuming the world? The answer is regulatory capital. And very specifically, you need to have a certain amount of regulatory capital in order to make a certain volume of loans, in order to run a certain profile of business. And so what you end up with people getting fixated on is this idea of return on equity, right? How much money is this bank making given how much regulatory capital they have?
And by regulatory capital, we literally just mean dollars sitting in an account there to pay back customers if needed.
Not exactly.
So please explain that.
God, regulatory capital is a very, very weird and complicated idea. The way to think about regulatory capital is not it's money sitting in the bank in like a vault. The way to think about regulatory capital is, let's imagine that tomorrow I had to completely liquidate the bank. I had to return all the deposit money, and I was able to call all of my loans back at 100% immediately. Your regulatory capital is whatever's left after that, right?
Okay.
And so it is, in that sense, a buffer on like a difference between what you owe and what you're holding today, but it actually doesn't and generally isn't held in cash at a vault. Instead, it'll be put into things that are potentially cash-like or easily liquidatable. So it'll be, some amount of it's going to be sitting in cash because you need it to make payments, but a lot of it will be sitting in, bonds, gilts, things that are earning you money, but which can be turned into cash tomorrow or within 90 days, generally.
Very, very low risk. Okay.
Yeah.
Okay.
Yeah. So you get into this idea of like return on equity, like how valuable, how productive is this business with the amount of regulatory capital that it has, right? If all you do is loans, there's kind of a ceiling on that, right? Because like lending is a competitive market, so you're going to be subject to competitive pressure. You can't lend beyond a certain level. Like the regulations set exactly how much capital you need for every loan that you make. But what makes a business really interesting is you can totally destroy this ratio if you have a lot of fee-based revenue, because suddenly the fee-based revenue has nothing to do with the regulatory capital stuff, right? It's just money that's flowing in from a completely different source. Mm-hmm. And so the interesting, and the same is also true for payments-based revenue, right? And so if you can have these like non-net interest-based revenues, you as a bank can look incredibly juicy to a classic bank investor, because they'll look at you and be like, oh, I'm used to seeing a return on equity of X, but these guys have 3 times that because so much of their earnings is coming from something that is not, in fact, like net interest. And so for us, again, as a business that's like 70, 80% fee-based, I'm like, anytime an investor talks to me about return on equity, I'm like, you're a moron. You've completely missed the forest for the trees, right? Like I'm not a business that you need to be thinking about with that as like your reference point.
Got it. Okay. So that's making money from fees is like particularly advantageous. It's not just the revenue that you're making. It comes with this outsized advantage that it doesn't have this regulatory capital requirement.
Yeah.
Okay. Very interesting. Cool. Okay. I want to, in the last sort of 10 minutes,
I'm sorry, I probably like destroyed your interview agenda. I remember you sent over 6 questions. I feel like we've made it through like 2 of them.
No, we are like totally on track. The last thing I want to cover is still like, why would you become a bank? And maybe, David, for this, I need you to take your Griffin hat off and I need you to just talk with regards to like everything you know about building a bank and being a bank. Because when I joined Monzo, 15 or so people, no customers. We were giving out these prepaid cards from our office, and we grew to hundreds of thousands of customers with 0 marketing spend. But we were on this path to become a bank. And at exactly the same time, in the same city, about 2 blocks away, Revolut was doing the exact same thing. And they were growing in a very similar way to us. We basically tracked number of customers equally in that first year, 2 years of our lives. And then Monzo got a banking license. And we were literally told, you cannot onboard more than this many people a month, which meant that we had to just stop onboarding people. And every time we tried to release a new product, the regulators wanted to see it. We had to go through all of these board meetings. We had to go through all these regulatory processes to get a new product released. And Revolut did not. And today, Revolut has something like 70 million customers worldwide. And Monzo has something like 12 million customers in the UK. And Revolut is worth something like 75 billion and Monzo is worth 5. So why would anyone get a banking license? And why is Revolut trying to get one in the UK?
So the thing that draws me to banks is very similar to the thing that draws me to technology businesses in the abstract, which is that they are the ultimate scale business. They have very high fixed costs, comparatively low variable costs, right? Each additional pound you take in deposits doesn't cost you anything, actually. But you need scale. You need scale really badly, like really, really badly. It goes back to that point I made earlier. You can't run a business, you can't run any bank in the UK for less than 12 million pounds. And if you are, you're going to be like taking some serious shortcuts. And that number does scale a little bit with growth. But if you've got the scale, man, I mean, the reason why Revolut wants it is because they've got the scale. And so the day they turn it on, it just blows that 12 million cost out of the water. It enables them to do so much more.
Because they're paying for all of those relationships with other banks, or the relationships with the NatWests, for example. Is it because of all of that stuff?
Partly that, but it's also because it lets them lend, right?
Okay.
And so you should assume, today, I don't know what their internal commercials are, but let's assume they are getting paid 3% on deposits. Because ultimately, like Revolut to another bank is just a depositor, and all their customers are just depositors. So let's assume they're getting 3%. I don't know if that's right or wrong. It's probably approximately correct. The day Revolut gets a bank license, they no longer, so they can now earn much, much more because they can lend those deposits. They basically, have tons and tons of regulatory capital, so that's not a problem for them. So that 3% suddenly becomes 5%, 6%, 7% on average, right? So, I mean, they kind of double revenue, basically, at least. They've got to pay some of that out to their customers, but they also earn trust. And the irony is, like, people trust banks to steal from them, but they don't trust them to fail. It's a funny way of framing it, perhaps, but like, it's one of the lessons from the financial crisis is like, people still think of bankers as fundamentally dishonest, but we place a lot of trust in banks not to fail. And the reason for that is that the regulatory framework is in fact very robust.
But don't you think the fact that Revolut have gotten to 70 or so million customers means that people are trusting it regardless?
Well, the other regulators aren't, and this is part of the problem, is that they're struggling to enter markets because the other regulators are looking at the UK and going, wait, how come your parent regulator hasn't given you the green light for this? And this is also why the parent regulator has held fire, is because they're like, look, we all have to go to Jackson Hole and the same kind of social events with these other regulators and bankers. If we approve you and then you blow a hole in whatever, Mexico, we don't want our friends to be mad at us. So, we have a sense of responsibility. The UK is still viewed as a gold-plated regulatory regime, and I think that's fair. I think that's probably pretty accurate.
So from Revolut's point of view, sure, they can make a lot more money by lending.
Yeah.
Maybe they can double their revenue, as you suggest. They can presumably also save some costs, these relationships that they have to have that they won't have to have. But the regulator might well turn around and say, okay, you can no longer onboard more than 2,000 customers a month, 4,000 customers a month. It will just kill their growth. Any new product they want to launch, the crypto products, the mortgage products.
Here's the thing, though. Yeah, a couple counterpoints to that. I think Monzo got a little bit unlucky. If I'm being very honest, I think Monzo probably also was sloppy. I think Revolut has had to build over. Revolut unquestionably has also been very sloppy, but they have spent years being told what the bar is before getting the bank license. Uh-huh. Monzo and Starling were both allowed to get the bank license while being sloppy, and the regulators changed their position on that pretty shortly afterwards. It's one of the reasons why it took Monzo 18 months and it took us 4.5 years, is that the regulators were like, okay, cool. This is working from a customer market competition perspective. This is not working in the sense that both of these organizations are actually pretty messy. And like Starling has had to eat some pretty big fines. Monzo's also had a couple of fines, right? We have not had any fines. Like, we haven't even had like minor regulatory issues on this, right? So the bar for entry has changed a lot. And what that means is you have less hostility on the other side. The other thing I would say is, on this kind of like experimentation with multiple products side, The thing that Monzo hasn't done, which Revolut has done, is Revolut operates a massive group structure in which they can park different regulatory obligations under different entities that are not the bank. So they can just bring it outside of the regulatory perimeter, which gives you a lot of freedom and flexibility.
And that's partly because of their international reach that they have just like gone after.
Yeah, it's a muscle that they've gotten good at, right?
Yeah. Okay. All right. So if you were Nikolai, you would be applying for this banking license.
I mean, look, if I was Nikolai, I would have a lot of very interesting problems to solve. He's an interesting guy. I think it makes sense. I think it makes a lot of sense for where they are. And the reason now that it's taking them so long to get it is that they will be by far the biggest bank, the biggest new bank to ever get authorized in the country by multiple orders of magnitude.
Yeah.
So it is not at all surprising me that they are having quite a drawn out experience.
Yeah. Okay. So in summary, becoming a bank is worth it. Obviously you think that you're building a bank. The costs, the revenues.
I don't know that I would do it again. Or let me put it differently. If I was going to do it again, I would want to do it starting with me having a lot more money. Like the thing that I get very envious of is looking across the pond at like Will Hockey and his ability to just go and buy Column for like $100 million, like, and not have external shareholders and just be able to do whatever he wants. Like that seems really nice. I would love to be able to do that. Unfortunately, that is not the reality for me. That's okay.
Okay. So in another world, you would have built Plaid first, made billions, and then done this.
I mean, I was nearly employee number 11 at Plaid, so I mean that's close enough, right?
Ooh, painful. All right. David, this has been fascinating. I now know a lot more about how to build a bank than I did before, even though I worked at Monzo when we were literally building a bank. So thank you so much for teaching us all about it, and really impressed and excited for what Griffin has to come. So thank you so much.